Welcome back to the Investor Professor podcast. This is Dr. Ryan Peckham, and this is episode 50. I wish I had like a kazoo. Shouldn't there be some kind of like celebration, 50 episodes? I don't know, but we'll just continue to make it do what it do. So on this episode, we are going to go over dividends and buybacks again, but this time I'm going to highlight specific companies for you because that's been one of the main questions that we've had here since we started discussing this. So on today's episode, we're going to look at companies that have already announced buybacks, dividends. I'm going to highlight them for you. We'll discuss what they do, how they can help you, and then I'll even give you an easy button at the end if that's what you're looking for. So excited you're here. Let's get to work. All right. Well, welcome back to the show, everybody. Appreciate you joining me once again. On today's show, we're going to discuss dividends and buybacks again. But like I said in the beginning, I'm actually going to highlight companies for you and show you how many years they've actually increased those dividend payments. And I think it'll be kind of an interesting perspective on this. But one thing I wanted to do is ever since I recorded last week's episode, which was on personal development books, I forgot one. And I wanted to bring that one up before we got started. But the book I forgot was John Maxwell. And that's probably one that, John Maxwell, everybody has at least one book probably from him when you discuss personal development. And so I think I don't know how many he's written. It's been a lot. I think they kind of start running together after a while. But my favorite one that he's done is called Talent is Never Enough. And the reason I enjoy that book so much is because we all know people who have been massively talented, probably haven't lived up to that potential. And so it's a great book for you, for maybe a teenager in your life, that shows that like talent isn't enough. It's one thing to have talent, but if you don't put some hard work behind it and really develop those skills, then it really isn't going to matter because, there's a ton of talented people out there, but there's not a lot of people that are willing to put in the time and effort to really put the work in. So that's the final one as an extension of last week's episode, Talent is Never Enough by John Maxwell. Okay, so back to this episode where we're going to go over buybacks and dividends. And I want to highlight for you some companies that have a history of raising their buybacks and also their dividends so you can kind of hit the sweet spot of investing. Now, one of the things I've said, I'm sure I've said it on this podcast. I know I've talked to clients about it over and over and over again. But really, when you start doing like a dividend-based strategy for your portfolio, it is in the beginning, it's like watching grass grow, right? You don't really notice that those dividends are helping you or the buybacks are helping you for a while. You just don't. I mean, it takes 3 to 5 years to really notice what's going on with dividends, buying you more shares, and seeing that compound effect take place. And obviously, the younger you are, the more pronounced this is going to be the longer you hold a stock. So it's important, if you're going to invest in individual companies for dividends, that you look at companies that have a history of raising those dividends over time, because it does act as inflation protection for you, but it also helps the compound effect happen more rapidly. And so you have to be careful here, because you will notice if you just do let's just say you do a general Google search of companies that pay high dividends, it's going to bring up some companies that pay some ridiculously high dividends of 9 or 10%. Now, as an investor, you have to ask yourself, is that something they're going to be able to keep up? Or is that just something that's really just trying to entice investors to buy into it just so they can get that high dividend for a while, but yet the stock doesn't do very well? And so it is more of an art than a science. And, you have to be careful of that. And remember, dividends are being paid out of companies' earnings per share. So, well, they're supposed to be. I mean, some companies actually borrow money to make this happen, which isn't a good long-term plan. But, for ease of conversation here, you want that to be paid out of earnings per share. So if a company is paying too much of a dividend, and it's basically all of their earnings, you have to remember that they're not going to have any money to invest back into their business. So you want a good dividend from a company, but it's more important to have something that is sustainable and something that the company can keep up, and the company isn't basically robbing the company's future to pay investors today. So it is this, Goldilocks, not too hot, not too cold medium that you're looking for, to where a company can pay something that is sustainable, but they also leave enough money for the company to be able to invest in things that they need to do so that they can keep that up. So without further ado, I'm just going to read some of these to you. We'll talk about the companies, what they do, and we'll look at this. So I'm looking at companies that have increased their dividend payments for more than 40 years. So think about that. That's from 1980 to today. And some of these are a lot further than that. But that is 40 years of consecutive dividend growth. I mean, that is pretty tremendous when you think about kind of the economic hardships that we've had in the last 40 years. You look at really high inflation in the early 80s. You look at the financial crisis of 2008. You look at the tech bubble bursting in 2000. You look at 9/11. You look at COVID. You look at all the things that we've gone over in the last 40 years, or things that have happened in the last 40 years. And these companies were still able to increase these dividends. And for me, that always makes me feel a little bit better, because I'm like, okay, if they can increase their dividends during these hard times, that's a kind of companies that I want to be partnered with, if you will. And again, this dividend piece doesn't have to be your whole portfolio, but it could definitely be a portion of your portfolio. So many of these names you're going to know, some of them you might not. One of them that you'll definitely know is Procter & Gamble. We've talked about them before. They have raised their dividend for the past 65 years in a row. 65 years in a row, Procter & Gamble has raised their dividend. Now, of course, when you go look at what Procter & Gamble makes, toothpaste, toilet paper, razors, feminine care products, laundry detergent, I mean, honestly, it's hard to go to a grocery store and not buy something that is made by Procter & Gamble. And so, they're a great company, especially when you think about inflation, because they're able to pass those costs down to consumers. And, they don't have tremendous growth, but their growth is pretty steady. And as long as people are going to the grocery store, they're going to spend money on something that Procter & Gamble owns. So the next one would be Emerson Electric, an electric company. Again, 65 straight years of raising their dividend. 3M, they have 63 years of raising their dividend. So 3M's most popular, most famous product is, Sticky Notes. Sticky Notes. So that stock has kind of floundered. That stock, let me see what they've done over the past, 5 years or so. Not that great. I mean, 5 years ago, you could have bought them for $200 a share. Now they're $145. So that's one that previous, if you look back 20 years ago, they did well, but since 2015 to now, they've kind of stalled out. So take that for what it's worth. The next one is Coca-Cola, 59 straight years of raising their dividend. Another consumer staple. Procter & Gamble's a consumer staple. Colgate-Palmolive is another one, 59 straight years of raising their dividend. Colgate, yes, that's the Colgate-Palmolive toothpaste, dish soap, another consumer staple. Johnson & Johnson, 59 years of raising their dividend. Hormel Foods, 56 years. Black & Decker, the tool company, 54 years. Cisco, 52 years. Now, this is Cisco with an S, not Cisco with a C, the technology company. Cisco with an S is a food distributor company. Target has raised their dividend for 50 straight years. Grainger, the industrial tool manufacturer, 50 straight years. AbbVie is a healthcare company, 50 straight years of increasing their dividend. AbbVie is a company, it's one of those companies you don't know it by the name, but you know it by the product. So AbbVie makes Botox. And I think I've said that before on here, but a great, oh man, that has been a great investment over the past 5 years. And the thing about Botox, man, once you get on that train, you got to stay on it. You got to stay on it. So it's just wonderful. You don't know if somebody's mad at you or not. They just look the same. It's wonderful. Abbott Labs, they're 50 straight years, another healthcare company. And so you'll notice like a lot of these are consumer staples, healthcare, like things that people have to buy, right? These are the things in the economy where it doesn't matter if you're making $300,000 a year, $50,000 a year. These are products that you're going to need no matter what your income level is. And I think that's important to highlight that you're going to notice that as we're highlighting these companies, these are the kind of companies that know that their income is going to be, the income from consumers is going to be coming into the company. And that's going to be a little bit different than when we look at buybacks. Okay, so there is something to distinguish between the two. Kimberly-Clark, another consumer staples, 50 straight years. Pepsi, 49 straight years for PepsiCo. And of course, you think of Pepsi, you think of obviously the drinks, but you got to remember that they own Frito-Lay. And Frito-Lay is a very profitable segment of their business with the snack foods. They make a ton of money there. Nucor, a company we highlighted not years ago, but a couple episodes ago. Nucor, the steel maker, 49 years of dividend growth. Archer Daniels Midland, 49 straight years. So that's a very solid company and one that's going to be very pertinent over the next year because they help with food growth. Consolidated Edison, 48 straight years, another electric company, another utility. So they are the main energy provider on the East Coast. So think about New York City, that sort of area. Great dividend growth on that company. That's just the utilities are just an expensive business to run. They're constantly having to fix things, upgrade terminals, things of that nature. So when you look at utilities, Con Ed, Emerson Electric, that balance between their earnings per share and what they're paying out in dividends is very important because they got to have enough money. They have to keep enough money to be able to upgrade those systems because it is costly. Lowe's, the store, Lowe's, the hardware store, 47 straight years. Walgreens, 46 years. McDonald's, 46 years. Walmart, 47 years. One I forgot, Cincinnati Financial and Insurance Company has 60 years. And I believe, where is Exxon is also on this list. Exxon has got a ton of years of raising their dividend. Sherwin-Williams, man, another boring one, but man, has that been a good investment over the years. So Sherwin-Williams, the paint maker, 42 years of raising their dividend. And so ExxonMobil's around 40, I believe, of raising their dividend. Chevron's up there as well. But those are the ones that I just highlighted that have 40 plus years of raising their dividend. So some of these have fallen off. One of them is AT&T because of what they did with spinning off Warner Brothers. Well, it became Warner Brothers. Now it's Warner Brothers Discovery. So they actually lowered their dividend because they broke up part of the company. So they fell off the list. But those are the companies that have raised their dividend the last 40 plus years. And so looking at that, I mean, those are the kind of companies, if you're looking to build up a solid base to your portfolio, those are some of the names you need to look at. I remember when I was building up my portfolio And still to this day, like I was like, okay, I want $100 of Coca-Cola. And then I was like, okay, I want $1,000 of Coca-Cola. Okay, I want $10,000 of Coca-Cola. Okay, I want $25,000 worth of Coca-Cola. And just slowly starting to build it up like that to where I got enough of a base in some of these companies to where you really start noticing those dividends buying you more shares. Because that's the deal, right? If you're going to invest in these companies and you're going to do it for a long period of time, go back to the DRIP episode, Dividend Reinvestment Plan, and you want to make sure that you turn on dividend reinvestment so that your dividends that these companies are paying you start to buy you more shares, right? That they start to buy you more shares. All right, so let's go look at companies that have announced buybacks. So here's the difference. When you do a dividend, right? Think about a company, right? So a company and its employees. If a company wants to help employees out, one of the things they can do is they can give you a raise or they can give you a bonus. So the thing about a raise is if they give you a raise, they got to keep it going, right? They got to keep paying you. If they give you a bonus, it's more of a one-time deal. Like we've come into some cash, and so we want to pay you a bonus, but we don't have to keep it going. Well, it's the same thing with companies and shareholders. So if they pay you a dividend, investors expect those dividends to continue. They are expecting those dividends to continue, especially investors that are retired and are looking to live off that income. And so let's say a company has a really good couple of years or they have a really good year and they want to reward shareholders. One of the things they can do is they can buy back shares, but that buyback isn't expected to continue. It's like they're going to say, okay, we're going to spend $3 billion buying back our own shares. And when that money's done, we might do another one or we might just not. And so it's a way of giving money back to shareholders, but they're not like married to having to do it forever. So the other thing is when you look at a dividend, investors have to pay taxes on that if it's in a taxable account. So, depending on your income, you could pay 0% on dividends. You could pay 15% or you could pay 20% if you're in the highest income tax bracket. And you can easily go do a search and find out where the tax breakdown is. But I think if, you make less than, I don't know how much it is, then you don't have to pay any dividend tax rates. Let's see real quick. Okay, found it. That's the awesomeness of the pause button. All right, so if you're married and you make less than $80,000 a year, then you don't have to pay anything for dividend taxes. If you're single and you make less than $40,000, you don't have to pay any dividend taxes. If you're married and you make between $80,000, this is when it really gets pretty amazing. $80,000 to $501,000, your dividend tax rate is 15%. If you're single, it's $40,000 to $445,000. And then anywhere above that, single or married, you're going to pay 20%, which still isn't bad. But when a company does a buyback, you don't have to pay any taxes on that, right? So this is why Warren Buffett likes to do buybacks for Berkshire Hathaway stock instead of dividends, because since he's the largest shareholder, if he pays himself a dividend, he's going to have to pay an ungodly amount of tax on that. Whereas if he just does buybacks, he doesn't have to pay taxes on it. So if you're not going to sell the shares, again, I know I've mentioned this before, but if you're not going to sell the shares, you'd like to have a buyback over a dividend, but there's a lot of people that are retired that really need that income, so they would rather have the dividend. All right, so let's go look at buybacks that have been announced. And when you look at buybacks, a lot of times we get we get focused on the number because it sounds really big, but what you want to look at when you hear that a company has announced a buyback, you want to look and see what percentage of their shares is that, right? So like, does it matter? I mean, if somebody announces a huge buyback, but it's only like 0.5% of their overall share count, you're really not going to be impacted by that. So pay attention to not only the amount of the buyback, but what percentage of their shares are they actually trying to remove from the market. So for example, some of the ones that we've highlighted already, Apple, $90 billion buyback, which is going to represent around 3.5% of their overall shares. And so that doesn't sound like a lot, but this buyback by Apple pushes their overall buybacks for the last 10 years upwards of $500 billion. And so that matters a lot because they have really reduced their share count over time pretty tremendously. Google is doing $70 billion, which is again going to be around, I think, 4%. Microsoft is doing $60 billion, same amount. Amazon's doing $10 billion, which that really doesn't represent very much of Amazon's overall share count at all. And so here's some others that really do. So Norfolk Southern, the railroad, they announced a $10 billion buyback, but that represents 14.6% of their shares. Okay, 14.6% of their shares, which that will definitely have an impact on their share. They're reducing their share count. AIG, the insurance company, $6.5 billion. That is 13.5% of their overall share count. Colgate-Palmolive, $5 billion, and that represents 8.1% of their shares. So I know I just highlighted them on the dividends. So not only have they increased their dividends that many years, but they're also doing a buyback, which is going to reduce their share count by 8%, which means that dividend is going to mean more for all the shares that are left. So that'll push that yield up as well. Let's see some other big ones here. Whirlpool, $2 billion buyback amount, but that represents 16.8% of their overall share count. You have Macy's, $2 billion, which almost represents 30% of their share count. That's pretty tremendous. Macy's has had a hard time over the last 10 years. Any retail company, my goodness, all sectors are not created equal. Retail has been really hard with the transition to e-commerce. Devon Energy, $2 billion. That represents 5% of their share count. They're also doing a dividend, and they're doing a special dividend based on how much money they're making. So that, obviously, being an energy company is key here. You look at, let's see, United Rentals, $1 billion. That is representing 4.5% of their overall share count. They do not pay a dividend, though. So you can kind of see where the sweet spot here would be if you can find companies that are doing a buyback and also paying you a dividend. Lululemon Athletica, $1 billion, and that only represents 2% of their shares. So that's what I mean. Like, and their stock has fluctuated a lot from $485 to $250. Now that it's been beaten up, you'll see that with companies this year, especially some of the tech companies that have been beaten up a lot. You know, they're going to use some of their extra cash to buy back their shares. Zebra Technologies. Zebra is a company I like. They're at $1 billion in share buybacks, and that's 5.8% of their share count. Zebra, you don't know them, but you know them. So Zebra, think of the black and white stripes of a zebra. They do all the barcodes. So when you go to the store and you do self-checkout and all that, that's Zebra Technology. So those are just some of the companies that are doing buybacks. There is a ton of companies that are doing buybacks, but again, you want to look for ones where it's actually meaningful to removing shares. Union Pacific did one, but they just announced they're gonna take off 100 million shares for their buyback. So sometimes they do it by dollar amount, sometimes they do it by shares. And so the other thing to keep in mind when you see a buyback is how long is it going to take them to do it. So most of them are going to do it within a year. That's pretty standard. And so the ones that I announced to you, they're going to do it on the open market, which means they're going to buy it just like you or I would. So they're going to find a day maybe when the market gets beat up and they're going to say, okay, buy back so many shares. So they do it over time at different price points, but they look to, buy back shares over a year period of time, and they retire those shares and take them off the market. So I hope this helps you. Again, I'm not your financial advisor. This is for entertainment purposes only. Talk to your financial advisor about these strategies before making any decisions. Past performance is not indicative of future results. But when you're looking at this, so that being said, talk to somebody about your portfolio and your dividend-based portfolio, because it does, this has a place in most people's portfolio, safe, kind of easy stocks. So I told you in the beginning, if you've waited this far, you deserve this. But I told you in the beginning, I'd give you an easy button, right? So the easy button is, let me find it. I had it up. So if you want, there is an ETF that just covers dividend aristocrats, right? So it's got 40%. It has about 40 stocks, and these are all stocks that we just discussed, stocks that have a history of raising their dividends year after year. And the symbol for that is NOBL, like Noble. That's the ProShares S&P 500 Dividend Aristocrat ETF. And if you look at this, it's basically just the companies that I've highlighted. Now, year to date, it's down 7%. But when you look at how the market's done this year, down 7% is not that bad. Its yield is only 1.94. I think you could, if you have the ability or you have, enough funds, you could basically build your own ETF in your portfolio for dividend aristocrats. But this one, it's currently trading at $93.99. And for that price, to be able to be invested in 40 companies that have a history of paying dividends and raising those dividends, it's not a bad place to be, for sure. So I hope that helps you out as always. If you have any questions, be sure to send those in. We will cover them for you. I appreciate your time. Go do some research on your own. Go find some companies that you think that you would like to invest in. The number one thing is trading too often. So match yourself with companies that you believe in, companies that that have a history of buying back their own shares and raising those dividends, and it'll be a good place for you to be. So I appreciate your time. I'll see you next time. Don't mistake activity for achievement. Have a good week, everybody.